Welcome back to episode 87 of Count Me In. I'm Mace Podcast about all things affecting the accounting and finance world. This is your host, Adam Larson, and I'm excited to introduce you to our featured guest, Jason Pierce. Jason is a partner with the firm Edelstein and Company in Boston, Massachusetts, where he specializes in financial forensics and business valuations. In this episode, he talks with my co-host Mitch about how a background in audit lends itself nicely to forensic accounting and business valuations. He also explains how the emergence of data and data analytics has played a major role in his job today. To hear more about fraud, forensics, and financial valuations, keep listening for our upcoming conversation.
So, Jason, I know you have a very interesting background, and I'd like to start off this conversation with you just kind of explaining how you started off in your accounting career.
Yeah, thanks, Mitchell. So I'm a military brat, which means we bounced around the country from place to place, which I also think kind of helps with fill in with this forensic accounting stuff, which we'll talk in a little bit, just from looking at things as an outsider. But where we landed when I graduated from high school and college was in Tennessee. And so after I graduated, I was looking at the time, going through another year of school due to the 150 hours necessary to get my CPA. But meanwhile, my dad had shipped off to Alaska, and I would go visit in the summers and see how awesome the summers were up there. And it just kind of drew me up to that place. Those of you who have been there know exactly what I'm talking about. So after graduation, then I moved up to Alaska, started working at a small CPA firm up there, and I did specialized in auditing for about 10 years before I jumped into this forensic accounting and business valuation area.
So how exactly does auditing turn into forensic accounting and your business valuation?
Yeah, for me, it was over time. So if somebody would have asked me in college, like what I'd be doing today, with forensic accounting side of things, I wouldn't even have known what that was. So just for the listeners, let's define forensic accounting. The easy definition of that is really the art and science of investigating people and money, where I think a lot of the misconception is just kind of chasing the money. But once you figure out the people side, then the money side becomes easier to figure out. So there is a relationship between the two. But so how it happened for me was, as I said, being a staff auditor in Alaska meant a lot of trips out to the rural communities, which we call the bush, right, where there's no road system. And but I'd be out there, and every now and then there would be a situation where the records are gone, the former managers are gone, or the city administrator, what have you. And so those audits then turned into a forensic investigation. And sometimes that meant just kind of figuring out what the heck happened. And it also, sometimes it meant like people made off with some money. And so we had to just kind of figure out what we call like pick and shovel sort of methodology, is understanding what happened and when, and how that translates to the financial statements at the end of the day.
So with that in mind, can you kind of tell us what it means to have a forensic mindset and how you were able to kind of apply some of, your auditing and accounting background into what you were doing with forensics?
Yeah, it's interesting with the forensic mindset compared to what one would traditionally think of as an auditor, that in an audit, you're looking for matching. So like uniformity, consistency, does the check or purchase order or invoice agree from the date, the payee or the vendor, the amount and the expense or whatever account code, do all those match with what's going through the general ledger? And so on the surface, you have this forensic or the audit mindset where you're digging through the general ledger, making sure that the financial statements agree, in all material respects and all that good stuff. But what the difference is from a forensic side of things is you're looking for differences. In other words, whereas on one hand, we're looking for that uniformity, where on a forensic side, we're looking for, let's say there's a $2,000 dual signing check limit, where in other words, if there's a check issued for more than say $2,000, it requires dual check signers. But lo and behold, there's a lot of checks for 1,900. In other words, if we're looking at things where we have the ability to look to see if is there round numbers, is there what we call there's a technique called Benford's law, where you could look to see from the placement of the digits in whatever sort of metric you're looking at, there should be some uniformity to it. And without getting into that, there's ways where you can test from a risk-based approach to identify like the nice round numbers, or there's a lot of checks that start with say threes, and that's disproportionate to what would be expected. So there's ways to look at things from a forensic perspective that are different from a traditional audit mindset, where you're just grabbing 40 to 60 cash disbursements and kind of checking those against the general ledger.
So now you have these two different mindsets and you've got experience with both. But today, I know you do a lot of work on business valuation. So how do auditing and forensic accounting mesh and ultimately allow you to come up with these business valuations?
Yeah, well, surprisingly or not surprisingly, there's a lot of accountants that are in this field. And I think primarily is because we know how things flow through the general ledger. We're also detail-oriented folks, and I think that's a key element. I'll come back to that. We know where to go on the tax returns to find information or what's missing from a tax return oftentimes. And really it's back to that, getting the story behind the numbers, right? We want to be able to take a situation where we're analyzing a business and see where it's been. But where the business valuation kicks in, it's really what's the worth going forward. So where it's been is important to understand the risk, and we could do some diagnostics from the financial statement analysis aspect. But the business valuation side of things, it's really like the present value of what the business is going to do. And so what we look to see, and that's where the forensic kind of overlays in with the valuation analysis, is because we are looking at sometimes individual transactions, but sometimes it is just uniformity from year to year. And let's say like the marketing expense was, let's call it 1% of revenue for the first 4 years, and then in the last 2 years it's been 3 to 5%. So we kind of wonder what's in that. Is that really just an investment in the business that we could use to justify why we're going to grow revenues, or is it because there's a brand new luxury vehicle that's getting run through the general ledger, or some trips to Vegas pre-COVID, what have you, that don't need to be in there? And so from a valuation side, we would adjust for those sort of transactions. But yeah, so from a transition from an accounting-based perspective to the forensic-based analysis and business valuation, call it forecasting, there is a lot of overlap. But where I think I would caution listeners is to have a solid understanding of finance, rather than just kind of assume that we can do a present value formula in Excel and think that we can just kind of run some of this stuff. Because the way that I know that I'm improving is to look to see how my previous valuation reports look. And I can tell you with certainty, because it's been long enough from the statute of limitations, that these things don't matter anymore. But my first business valuations were just that, where I thought I knew what I was doing. But when you look at them today, it's like, wow, there's a lot more nuance.
So you talked about diagnostics, you talked a little bit about analysis. My next question deals with those detailed analyses, some of the nuance that you were talking about, and how do you go about identifying some of that? Particularly in your perspective, I'd like you to share, what role does data analytics play in your business valuation today? And does it tie into forensic accounting even, in taking a step back further?
Oh, you bet. So let's take a situation where most of the activities that we look at, whether we're dumping things out of the general ledger into Excel, or we just are doing our own calculations in Excel, most things can be done in that, or I don't want to just limit it to Excel, but spreadsheet type activity. But what happens if you have millions of transactions, or you're looking for something specific where you have two different databases? Where in those situations, we rely on those data analytics software. Think like IDEA or ACL, if that's a familiar term for folks, where, as an example, we had a food delivery business case with 12 million transactions, and we had to do some analytics on that. It just wasn't real convenient in Excel. So we put that information into the data analytics software, where you could look to see, like, what about entries on weekends? I talked about the Benford's Law. That's certainly part of that analysis. You can look to see is compared the vendor database to the employee database and see if there's some commonalities between either phone numbers or addresses, things like that you just can't do with the day-to-day sort of spreadsheet analysis. So the data analytics is a big piece of this, as I was saying, like the important characteristics of a forensic accountant is that data analytics side of things. But there is, for those of you who are interested in it, there is a course offered by the IMA that you could get 21 hours of CPE, and it's literally called Data Analytics and Visualization. It's put on by the University of Illinois, and it gets into some Excel stuff, but it also gets into Tableau and some other areas that your average, say, CFO or controller might not be familiar with, either because of their job duties or just without having the need to perform those type of activities. But yeah, that's a great course. I'm halfway through it right now.
So with these analytics and the different mindsets that you put in place on the day to day with the different clients or companies you're working with, what are some of the warning signs of fraudulent numbers? Like, what are some of the things that really stick out to you and make it obvious that you need to dig into these numbers a little bit more?
Yeah, well, what's most common on my side, because I'm not in industry right now. I'm working at a CPA firm, is where people will come to me and say, Jason, I don't know what's wrong. I'm bouncing a lot of checks. Meanwhile, I think I'm making money. So like that's very common. Other activities where this comes into play, it's the mindset that having the ability to trust people but verify. And if you think of that, I don't want to keep going back or go to the fraud triangle, but it is appropriate. So for those of you who don't know, that's where the opportunity, the pressure, and rationalization meet, to where a fraudster will then you're more likely than not to have some fraud occur in your organization. So we can't do anything about the pressure or the rationalization, because that's to the individual, but we can do a lot for the opportunity and minimize that. And if even if people think that you're watching, then they're less likely to do so. And if you haven't seen it, there is an article in the strategic finance publication by the IMA last month called Fighting Fraud in the Workplace. It gets into some of the areas that one can do to strengthen up the internal controls or analysis of transactions or surprise audits, those type of things that while we trust our employees and we want to make sure that they learn and grow, we also want to let them know that somebody is watching.
I think a good way to really wrap up this conversation is, do you have any notable cases or anything that really highlights something that was most interesting to you through your career, whether it was, early on with the audits or the forensic trails? What is it about this that's so interesting, and anything specific you can share with our listeners that maybe they can apply or pursue?
If we think about one of the ways that, without talking just litigation, is a situation that I've come across regularly, which is the use of multiple entities to basically have a workaround from the general ledger. And we see that with the Enron company is with the SPEs, right? So one of the things I see is, say, where you have a business owner that has a related entity, whether it's the real estate or just, like a subcontractor kind of management type entity, where they have the ability to kind of shuffle costs or fees around. And if we don't have the ability to look to see what's on the other side of that, then we're at a disadvantage. So I would say to be cautious as I'm putting myself as a user as a listener of this podcast, like a CFO controller type person, that we would want to have the data analytics capability where we could do that merging of databases. It's easy to say, right? This is all in our free time, but having the ability to think critically of, say, shareholder loan accounts, or due to, due from accounts, or, management fees with this related company, or rental expense. So there's a lot of areas, a lot of accounts that have the potential for abuse. Even think like employee expense reimbursements. The data analytics works well with expense reimbursements. And again, if people think that their expense reimbursements are getting looked at, they're less likely to try to push things through the system when they know somebody's going to be looking at it. So yeah, I think some of the lessons that I've learned from like the litigation side and quite frankly, like the criminal cases I've had too, tend to fall into some of those accounts where, it's absent just straight cash, where it's not going to hit the books anyway. But if we're just thinking of, there is a transaction that has a debit and a credit, and we see that there's, let's call it an expense, like the debit side of things that's floating through the general ledger, where could that credit go? I mean, it could go in that shareholder loan account. It could be from, shareholder contributions. It could be in that due to, due from account. There's lots of ways that this thing can go. And quite frankly, I still get out the T accounts and just kind of walk through like, well, wait, how does this even make sense?
This has been Count Me In, IMA's podcast, providing you with the latest perspectives of thought leaders from the accounting and finance profession. If you like what you heard and you'd like to be counted in for more relevant accounting and finance education, visit IMA's website at www.imanet.org.